This video is going to discuss the third major section of the income and expense page, which is called non-current inventory. Now, actually, the application lists that as item number 4 because it calls expenses section 1, income revenue section 1, expenses section 2, and it says section 3 is net income from operations. So it calls the non-current inventory section 4, but it's the third major component of the income and expense page. It's very important to get the non-current inventory completed correctly because in virtually all cases the non-current inventory should yield a negative amount. It should virtually never show a positive amount, and we'll explain why that would be the case. In category 4, in the beginning year of the SAE, the beginning inventory, which would be from the basic setup page, will go right here in that first year. Now remember, that beginning inventory should be land values at the original purchase price, breeding livestock raised at its original value that it was estimated at market value when it was converted to the breeding herd, plus any increases for maintenance costs. And all purchase breeding stock and all machinery, equipment, and buildings should be at their depreciable balance. In other words, the undepreciated amount. So that beginning inventory will simply go right here in line item E. At the end of the year, or at the end of the first year, or then subsequently at the end of each year, the closing inventory should continue to hold land at that original purchase price. It should further depreciate any machinery, equipment, buildings, and purchased breeding stock. You could have small increases in raised breeding stock, but it only should be in the years prior to their maturity. So, for example, if you started with a heifer worth $800, in year number 1 you might increase her a few dollars to represent her maintenance cost, and in year 2 you might increase her a few dollars for maintenance costs, not market value. But once she becomes mature in the breeding herd, then that number should stay constant. So this is one place you might have a small increase. Okay, item B is simply transfer in from the current assets. This is where you would actually transfer in that heifer calf. In other words, she was a current asset in the first year, but in the second year you decided to keep her in the breeding herd, so she would be a negative in the current assets, but she would be a positive in the non-current assets. Contributed inventory, this is where gifts would be listed at their value at the time of the gift. Purchases, this is where you would record a purchase of machinery, equipment, land, breeding stock, so forth. Line F is where you record sales of breeding stock, old machinery, or land sales. One of the things that we notice about a lot of the applications, particularly in livestock, there's confusion about where you sell aged breeding animals. Well, they should go right here in line item F. They should not be up in that income revenue section. The sale of aged breeding stock raised or purchased should go right here, and that value should be reduced in the closing inventory. So if you had an old cow on the books, and she was sitting on the books at $800, and you sold her for 1,000, then the closing inventory would be reduced by 800, but you'd have $1,000 sale. That's another place that you could have an increase in this section. Okay? All right, non-cash sales, you can read the little help section here. It simply represents trading out non-current assets for items that are used or in expenses. If this section is completed properly, the net non-current transactions right here would normally be nothing more than your annual depreciation. Now, if you increase the value of raised breeding stock slightly due to maintenance costs, it would offset some of the depreciation. And if you sold a non-current inventory item for more than it was already being valued at, you could have a positive number and it would offset the depreciation. The only way that you can get a positive number in this net non-current transactions is that the increase in the value of raised breeding stock and sales above inventory values would have to be great enough to offset depreciation of all other assets. Now, that would be extremely rare. So what judges are beginning to learn is that if there's a positive number in this line item H, it's a red flag because you should never consider SAE income from any appreciated value of non-current assets. That's just inappropriate. That's been really hard to deal with in these applications, but we're getting much better. But you should never have, like breeding stock, for example, and simply say those things got more valuable and call it income. One of the examples I like to use is thoroughbred horses. Suppose you bought a mare and you bought her. We'll use small numbers. Let's say you bought her for $2,000 and you put her on well, I'll use a 10-year inventory. I mean, excuse me, a 10-year life. That's too long, but it just makes the arithmetic easier. And you were going to depreciate her to $200 a year. Suppose you've had her 4 years, so you should have $800 of depreciation. You take that 800 from that 2,000. That mare should be on your closing inventory at $1,200. Next year she'll be on it at $1,000. It'll come down each year. What if one of her offsprings won some major races and somebody come by your farm one day and offered you $20,000 for that animal? You can never value that animal at $20,000. It just can't be. There can't be an appreciation of assets that's called income. The only time you could realize that increase in income would be if that animal was sold. So that horse, even though it might have a fair market value of 20,000, on the closing inventory each year it continues to decrease by $200. Certainly you never would increase the value of machinery and equipment on the SAE Section 4. They would always continue to fall every year. Line item 5 here is simply the net transactions from Category 4 on non-current inventory. This is the line that should in almost all cases be a negative number. Item 5A is simply where you take the net income from operations, which is item C or line C, and add it to line A. So this becomes basically your net income each year of the SAE. It's it's very important to understand this line item 6 because there's been some questions in the last couple of years. The operating profit margin is simply a ratio that is calculated using your net income as a percent of total sales. But item B has confused many people because what it does, it checks this item 5 here to see if that number is a major portion of your total profit. Because we realize and know that line item 5 should rarely be a positive number. If it is a positive number and then it's a large segment or section of your net income, that's a huge red flag in terms of possible appreciation of assets. So what happens is this template will give a percent right here. If these percentages are high at all, it's going to key the judges to understand that there's probably some mistakes in this non-current inventory. So the main thing to remember about the non-current inventory in line item 4 is that the value of assets should in almost all cases never increase. Land should remain constant at its original purchase price, and all machinery, purchase breeding stock, buildings should be depreciated, which means they go down in value. One closing comment I would mention, be sure when you're dealing with depreciation of assets that you don't create a situation where the depreciation is so low that it would take an unreasonable length of time to depreciate the asset's total purchase price. For example, if you bought a herd bull, you certainly wouldn't want to put the estimated life of that herd bull at 20 years. You wouldn't want to go buy a new hay baler or a new tractor and put the estimated life at 30 years. You should keep those estimated lives at some reasonable amount, because when you look at the opening and inventory on the basic setup page or the ending inventories on the next page of the financials, it's fairly easy to estimate the life based on the numbers that are presented, so the judges can determine about how long you have that depreciation set up. So keep that reasonable so that it makes economic sense.